Before we dive in, it is critical to understand that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent, and this presentation should not be considered financial or legal advice. The world of insurance is complex and varies significantly by state and individual circumstances. You should always consult with a qualified and licensed professional before making any decisions about your own insurance coverage. One of the biggest financial mistakes you can make isn't in the stock market or with your credit cards. It happens in about 5 minutes with a few clicks on a website, and most people have no idea they've even made it until it's far, far too late. It's the mistake of choosing the wrong car insurance, and it can cost you everything. Let me tell you about a guy named David. David was smart with his money. He budgeted, he saved, he was trying to get ahead. So when it came time to renew his car insurance, he saw two options. One was about $40 a month. The other was over $100. He thought, 40 bucks? That's a no-brainer. He was driving a 10-year-old Honda, nothing fancy. He was a safe driver, never had an accident. So he clicked the box for state minimum liability, paid the bill, and felt pretty good about saving himself over $700 a year. He put that money toward his student loans. A smart move, right? 6 months later, David was driving home from work. It was raining, the roads were slick. He was stopped at a red light, and his foot slipped. Not a big deal, his car just rolled forward at maybe 3-4 miles an hour and gently tapped the bumper of the car in front of him. It was a brand new Lexus SUV. The driver, a lawyer, got out. There was barely a scratch on the Lexus, just a tiny scuff on the plastic bumper. David's Honda was fine. They exchanged information. David apologized, a little embarrassed but not worried. He had insurance after all. That's what it's for. A week later, the first letter arrived. It was from the Lexus owner's insurance company. The estimate to repair the tiny scuff was $4,000. It turns out, behind that plastic bumper cover was a network of parking sensors and collision avoidance radar. They couldn't just buff it out. They had to replace the entire bumper assembly and recalibrate the sensitive electronics. David forwarded the letter to his insurance company. He was annoyed, but he figured they'd handle it. His insurance company called him back a few days later. They said, "Good news, Mr. Miller. Your policy covers this." David was relieved. Then they said, "Your state minimum property damage liability limit is $5,000. So we will pay the $4,000 for the repair." For a moment, David felt that relief wash over him again. But the agent wasn't finished. "However," she said, "we just received a notice of representation from the other driver's attorney. He's claiming a neck and back injury from the impact." David was stunned. "Injury? I was going 3 miles an hour. We just tapped bumpers." The agent's voice was calm, clinical. "Yes, we understand. But he went to the emergency room and he's now seeing a chiropractor. His initial medical bills are already over $8,000, and he is claiming he will be out of work for several weeks." And that's when the floor fell out from under David's world. The agent continued, "Your state minimum bodily injury liability limit is $15,000 per person. The other driver's bills and lost wages are already projected to exceed that. We will pay up to your $15,000 limit, but you will be held personally responsible for any amount above that." Let's just pause there. Let that sink in. David, who tried to do the right thing and save a little money, was now on the hook. The other driver's medical bills climbed to $22,000. He sued David for the $7,000 his insurance didn't cover, plus another $30,000 for pain and suffering. The legal fees to defend himself were $5,000 out of his own pocket before he even stepped into a courtroom. All in all, from a fender bender at a red light that he thought was no big deal, David, the responsible saver, was now facing a bill of over $40,000. His savings were wiped out. He had to borrow money from his parents. His wages were garnished. That $700 he saved on his premium suddenly seemed like the most expensive mistake of his life. Now you might be listening to this thinking, "That's a horror story. That's an extreme case. The other driver was a lawyer, of course he sued." And you might be right. But what if you're wrong? What if the car you hit isn't a Lexus but it's a Tesla, and you damage the battery pack, a $50,000 repair? What if the person you hit isn't a lawyer, but a construction worker who genuinely can't work for 6 months because of a back injury? Are you prepared to pay their salary for half a year? This is the razor's edge that millions of American drivers are unknowingly balancing on every single day. They think, "I have insurance" means, "I'm covered." But it doesn't. The gap between what the law requires you to have, the state minimum, and what you actually need to protect yourself from financial ruin is a chasm, and falling into it can derail your entire life. That is why you are watching this video, because you're not going to be David. Over the next several minutes, we are going to pull back the curtain on the confusing, jargon-filled world of car insurance. We are going to eliminate the confusion. I'm going to give you a crystal clear understanding of what state minimum insurance actually is, what it covers, and most importantly, all the terrifying things it leaves you exposed to. Then we're going to define what people call full coverage, breaking down every single component from collision and comprehensive to uninsured, motorist, and MedPay, so you know exactly what you're buying and why. But we're not just going to define terms. I'm going to give you a simple, practical framework you can use right now to decide which level of coverage is right for your car, your budget, and your financial situation. We'll look at real-world numbers and scenarios. We'll talk about deductibles. We'll expose the common myths and misconceptions that cause people to be dangerously underinsured or, in some cases, to overpay for coverage they don't even need. My goal is simple. By the end of this video, you will have more clarity and confidence about your car insurance than 99% of the drivers on the road. You will be able to look at your own policy and know for a fact whether you are truly protected or if you're one unlucky moment away from a financial nightmare. Because the difference between these two choices isn't just a few dollars a month. It's the difference between a minor inconvenience and a life-altering catastrophe. So, let's start by dissecting the most common and most dangerous choice of all, state minimum liability. You are going to be absolutely shocked by what it doesn't cover. Let's start with the name. State minimum liability. The word liability is the key. It means responsibility. So this insurance isn't for you. It's for the person you hit. Let me say that again because it's the most misunderstood concept in all of car insurance. State minimum liability does not pay one single penny. It's a flimsy, paper-thin shield you're legally required to hold up for everyone else on the road. And what about your own car? If you cause an accident with only state minimum coverage, and your car is a twisted wreck on the side of the highway, you get a check for exactly $0. You're on your own. You'll still be making payments on a car you can't drive, and you'll have to figure out how to buy a new one, all while dealing with the fallout from the accident. So what exactly does this liability coverage protect the other driver from? It's broken down into two parts: bodily injury and property damage. And this is where that confusing string of numbers you see on your policy comes in, like 25/50/25 or 30/60/25. It's not a secret code. It's a map of how little protection you actually have. Let's use a common example, the 25/50/25 plan. The first number, 25, stands for $25,000. That is the absolute maximum your insurance will pay for any single person's medical bills in an accident you cause. The second number, 50, stands for $50,000. That's the maximum your insurance will pay for all medical bills for everyone in the other car combined for that single accident. And the last number, 25, is $25,000. That's the maximum your insurance will pay for all property damage you cause. That means their car, the lamppost you hit, the fence you ran through, everything. Now you might hear those numbers and think, $50,000 for medical bills? $25,000 for car repairs? That sounds like a lot of money. I'm a safe driver. I'll probably never even need it. And that single thought is the most expensive assumption you can possibly make. Let me introduce you to Mark. Mark is a good guy. He's 28, works in IT, and just bought a reliable 4-year-old Honda Civic. He's responsible. He knows he needs insurance. He gets a few quotes online and sees a huge price difference. One is $45 a month. The other is $120. He looks at the cheap one. It's from a reputable company and, most importantly, it meets the state's legal requirement. It's the 25/50/25 plan. He thinks, I'm saving over $70 a month. I'm a safe driver. I don't speed. I don't text and drive. This is just a formality. He signs up for the state minimum plan and feels smart about it. 6 months later, Mark is driving home from work. It's been a long day. He's stopped in traffic and his phone buzzes. It's a text from his girlfriend. He knows he shouldn't, but he glances down for just a second. A single second. In that moment, the car in front of him, a brand new Tesla Model Y, which had started to move, suddenly stops. Mark's foot doesn't get to the brake in time. It's not a huge crash. Maybe 10 miles an hour. Bam! A gut-wrenching crunch of metal and plastic. Mark's heart sinks. He gets out. The Tesla's bumper is cracked and dented. His own Honda has a crumpled hood and a smashed headlight. A family gets out of the Tesla. A husband, a wife, and their teenage daughter in the back seat. They seem shaken up, but nobody is obviously bleeding. The police come, a report is filed, and Mark reports the claim to his insurance. He's stressed, but he thinks, okay, this is what I have insurance for. They'll handle it. This is where Mark's world begins to unravel. A week later, the calls start. The husband and wife from the Tesla are both experiencing severe whiplash. The wife, who had a pre-existing back condition, is in excruciating pain. Their daughter has a concussion from her head hitting the side window. They've all been to the emergency room. The ambulance ride alone was $2,000. The ER visit with CT scans for all three of them was over $15,000. The bills keep coming. MRIs, specialists, physical therapy 3 times a week. The wife needs epidural injections for her back pain and can't go to her job as a dental hygienist. Let's look at the numbers. The wife's medical bills quickly soar past Mark's $25,000 per person limit. Her bills alone reach $40,000. The husband's bills are $18,000. The daughter's are $12,000. The grand total for their medical care is $70,000. Mark's policy has a $50,000 per accident maximum. His insurance company pays that $50,000 and closes the checkbook. But there's still $20,000 in medical bills left over. Who pays for that? Mark does. But it gets so much worse. Remember the property damage? That Tesla Model Y bumper? It's not just a piece of plastic. It's a sophisticated piece of technology housing ultrasonic sensors, cameras, and radar for the autopilot and safety systems. The initial estimate to replace the bumper, repaint it, and recalibrate all the sensors is $19,000. But then the body shop discovers a small, hidden crack in the high-voltage battery casing, a known issue in rear-end collisions with Teslas. The battery has to be replaced. The final repair bill for the Tesla is not $19,000. It's $41,000. Mark's state minimum policy has a $25,000 property damage limit. His insurance company writes a check for $25,000. That leaves a $16,000 shortfall. Who pays for that? Mark does. So now, Mark is personally on the hook for $20,000 in medical bills and $16,000 in car repairs. That's $36,000 he doesn't have. He thinks the nightmare is over. It has just begun. A month later, a certified letter arrives. It's from an attorney. The family from the Tesla is suing him. They're suing him for the unpaid medical bills. They're suing him for the unpaid portion of the car repair. And they're suing him for the wife's lost wages, which amount to $8,000. And then there's the final terrifying part of the lawsuit: pain and suffering. Mark is now facing a lawsuit for over $100,000. His insurance company hires a lawyer to defend him as per the policy, but they make one thing crystal clear. They are only obligated to pay up to the policy limits of $25/50/25. Anything beyond that is his personal responsibility. Mark's $45 a month smart decision has led to a 6-figure lawsuit. His savings are gone in an instant, eaten by his own legal fees. The court enters a judgment against him. His wages are garnished. A huge chunk of every paycheck is now automatically sent to the family he hit. His dream of buying a house is gone. His financial future is destroyed. He may even be forced into bankruptcy. And through all of this, what about his 4-year-old Honda Civic? The one with the crumpled hood? It was declared a total loss. The cost to repair it was more than it was worth. How much did Mark's state minimum insurance give him to fix or replace his own car? $0. Not a dime. He was still making a $300 monthly payment on a car that was sitting in a junkyard, and he now had to find a way to get to the job that was having its wages garnished, all because he glanced at his phone for 1 second, and because he chose an insurance policy that offered him a catastrophically false sense of security. This isn't a scare tactic. This isn't an exaggeration. This exact scenario plays out in every state every single day to people just like Mark. State minimum insurance is not it's a bet against reality, and the stakes are your entire financial life. The law says you have to have it, but the law sets the bar so low, it's practically underground. Following the law is not the same as protecting yourself. So, if state minimum is a disaster waiting to happen, and understanding that they are a floor, not a ceiling, and the first step is to raise that floor significantly. So let's talk about what significantly means. For most financial experts, and for anyone who has anything to lose, a savings account, a home, future wages, the bare minimum isn't 25/50/25. The real starting point, the intelligent baseline, is often cited as 100/300/100. Let's break that down. $100,000 in bodily injury liability per person, $300,000 in bodily injury liability per accident, and $100,000 in property damage liability per accident. Now I know what you're thinking. That sounds like a massive jump. It sounds expensive, and it sounds like overkill. Do I really need that much? Let me paint you a picture. It's a rainy Tuesday evening. You're driving home from work, maybe a little tired, a little distracted. The traffic in front of you suddenly brakes hard. You react a second too late, your tires hydroplane on the wet pavement, and you slam into the back of a brand new SUV. The impact shoves that SUV forward into the back of a luxury sedan in front of it. A 3-car pileup. And it was your fault. Everyone seems okay at first, shaken up but walking around. But the damage is done. The police arrive, reports are filed, tow trucks are called. And in the days and weeks that follow, the real nightmare begins. The driver of the SUV, a father, starts experiencing severe back pain. His wife has whiplash. Their 2 kids in the back, while physically unharmed, are traumatized. The driver of the luxury sedan, a high-earning consultant, also has neck injuries. Let's do the math with your state minimum 25/50/25 policy. First, the cars. Your $25,000 in property damage is a joke. The brand new SUV has $28,000 in damage. It's nearly totaled. The luxury sedan? That has another $35,000 in damage. The total property damage bill is $63,000. Your insurance writes a check for $25,000. You are now personally on the hook for the remaining $38,000. They will sue you for it. And they will win. Your savings? Gone. Your wages? They can be garnished for years. But we're just getting started. Now come the medical bills. The father in the SUV needs back surgery. His medical bills, physical therapy, and lost wages from being unable to work climb to $70,000. His wife's whiplash treatment and therapy costs $15,000. The consultant in the luxury sedan has medical bills and lost income totaling $60,000. The total medical bill for the accident is $145,000. Your policy has a $50,000 limit for all injuries in a single accident, and it has a $25,000 limit for any one person. So, for the father with $70,000 in bills, your insurance pays out the max, $25,000. He is now looking at you for the other $45,000. For the consultant with $60,000 in bills, your insurance pays out another $25,000. He is now looking at you for the other $35,000. Your $50,000 per accident limit is now maxed out. What about the wife with $15,000 in bills? Your insurance has nothing left for her. She is now looking at you for the full $15,000. Let's tally up your personal debt from this one momentary lapse in judgment. $38,000 for the cars, $45,000 for the father's remaining medical bills, $35,000 for the consultant, $15,000 for the wife. That's a grand total of $133,000. A debt that will follow you, crush you, and fundamentally alter the course of your life. All because you chose the cheapest possible insurance. Now let's rewind. Let's imagine on that same rainy Tuesday, you had the 100/300/100 policy. The property damage is $63,000. Your policy covers up to $100,000. The insurance company writes the check. You pay $0 out of pocket. The medical bills. The father's $70,000 is fully covered, because your per person limit is $100,000. The consultant's $60,000 is fully covered. The wife's $15,000 is fully covered. The total medical bill of $145,000 is fully covered, because your per accident limit is $300,000. Your insurance company handles everything. You don't get a single threatening letter from a lawyer. Your savings are safe. Your future is intact. You get to learn from your mistake without having it financially ruin you. And here is the most important part, the secret that insurance companies don't exactly shout from the rooftops. The price difference between that state minimum policy that leaves you exposed to a six-figure lawsuit and the 100/300/100 policy that actually protects you is often shockingly small. We're not talking about doubling or tripling your premium. For many drivers, it might be an extra $15, $20, maybe $30 a month. The cost of a few cups of coffee. You get 4 times the property damage coverage and 6 times the bodily injury coverage for a fraction of the cost. There is almost no other purchase in the world where you can get that much more protection for that little an increase in price. Raising your liability limits is the single most cost-effective decision any driver can make. But we've only solved half the problem. Everything we've just discussed, liability insurance, is about paying for the damage you cause to other people. It's about financial responsibility. It protects your assets from them. But what about when it's the other way around? What happens when someone else crashes into you? What happens when they're the one who is texting, the one who ran the red light, and they're the one who has that flimsy state minimum policy? Or worse, what if they have no insurance at all? Picture this. You're sitting at a green light, waiting to make a left turn. Out of nowhere, a speeding car blows through the red light, T-bones you right in the driver's side door. The impact is violent. Your car is destroyed. You're injured. The other driver doesn't even stop. They peel out and disappear down the street. A hit and run. The police show up, they take a report, but they're honest with you, the odds of finding this person are slim to none. So you're standing on the side of the road, looking at the twisted metal that used to be your car. Your arm is throbbing. You know you need to go to the hospital. And a terrifying thought creeps into your mind. Who is going to pay for this? The person responsible is gone. Your liability insurance? That's for when you're at fault. It does absolutely nothing for you here. So what now? Are you just out of luck? Forced to pay for your own medical bills, your own lost wages, your own car repairs, all because a criminal smashed into you and fled? This is where the next critical layer of your insurance policy comes in. It's called uninsured and underinsured motorist coverage. And it is not an exaggeration to say it is one of the most important coverages you can possibly buy. Because this coverage, it protects you from the very people we've been talking about. It protects you from the drivers carrying state minimum policies, or carrying no policy at all. Think of it like this. Uninsured motorist coverage, or UM, essentially steps into the shoes of the at-fault driver when they have no insurance. Your own insurance company pays for your injuries and damages, just as the other driver's company would have if they'd had a policy. It covers your medical bills, your physical therapy, your lost wages, your pain and suffering. Then there's underinsured motorist coverage, or UIM. This is for the scenario where the at-fault driver does have insurance, but it's that terrible state minimum 25/50/25 policy. Let's say they crash into you and your medical bills are $80,000. Their policy will only pay out its maximum of $25,000. UIM is what kicks in to cover the $55,000 gap that the other driver's pathetic policy couldn't handle. In many states, when you buy liability insurance, you're automatically offered UM and UIM coverage in the same amounts. So if you get that 100/300/100 liability policy, you can get 100/300 in UM/UIM coverage to protect yourself. And you absolutely should. Statistics show that roughly 1 in 8 drivers on the road in America is completely uninsured. That's more than 12%. In some states, it's as high as 1 in 4. You are sharing the road every single day with millions of people who have zero ability to pay for the damage they might cause you. Relying on them to do the right thing is not a strategy. It's a gamble you can't afford to lose. So now we've built a solid foundation. We've raised our liability limits to 100/300/100 to protect our own assets from a major lawsuit. And we've added uninsured and underinsured motorist coverage to protect ourselves from the irresponsible drivers out there. We've protected our money and we've protected our bodies. But there's still one giant, expensive piece of this puzzle sitting in your driveway. What about your car itself? What happens if you hit a deer? Or a tree falls on your car? Or it gets stolen? None of the coverages we've talked about so far will pay a single dime to repair or replace your own vehicle. For that, you need to enter the world of what people commonly, and a little inaccurately, call full coverage. So let's get one thing straight right away. Full coverage isn't a real insurance product. You can't call your agent and say, "Give me the full coverage special." It's a slang term, a piece of industry jargon that's leaked into the mainstream. And what it really means is a policy that bundles together 3 core components. First, the liability coverages we just talked about, the ones that protect you from financial ruin if you hurt someone else. And second, 2 brand new types of coverage that are all about one thing: protecting your car. These 2 coverages are called collision and comprehensive. They are the heart and soul of what people mean when they say full coverage. Let's start with collision. The name is pretty self-explanatory. Collision coverage pays to repair or replace your vehicle if it's damaged in a collision. This could be a collision with another car, or it could be you backing into a light pole, swerving to miss a squirrel and hitting a guardrail, or flipping your car on an icy road. The most important thing to understand about collision coverage is this. It pays out regardless of who is at fault. Let's imagine that scenario again. You're sitting at a green light, and someone plows into the back of you. They have the bare minimum state liability coverage, which we now know might only be $10,000 or $15,000 for property damage. But your brand new SUV has $40,000 in damage. Their insurance will pay its limit, let's say $15,000, and then what? They're on the hook for the rest, but what if they're broke? Are you going to spend the next 5 years in court trying to get the remaining $25,000 from someone who doesn't have it? Good luck. This is where collision coverage becomes your financial superhero. You file a claim with your own insurance company. They assess the damage and they pay for the repairs. Then, their legal team will go after the at-fault driver and their insurance company to get that money back. That process is called subrogation, and the best part is it's their headache, not yours. You get your car fixed and you move on with your life. Now what if the accident was your fault? You glance down at your phone for a split second, and you rear-end the car in front of you. Your liability coverage will pay for their car repairs. But your car, with its crumpled hood and leaking radiator? Without collision coverage, that repair bill is 100% on you. With collision, you're covered. But there's a catch. And it's a big one. It's called the deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. Think of it as your share of the cost. Deductibles for collision coverage typically range from $250 to as high as $2,000, with $500 and $1,000 being the most common. So, if you have a $1,000 deductible and you get into an accident that causes $8,000 in damage to your car, you pay the first $1,000. Your insurance company then pays the remaining $7,000. If the damage is only $900, you're on your own. The claim is less than your deductible, so the insurance company pays nothing. This is a fundamental trade-off in insurance. A higher deductible means you're taking on more personal financial risk, so the insurance company rewards you with a lower monthly or semi-annual premium. A lower deductible means the insurance company is on the hook for more, so they charge you a higher premium. Choosing your deductible is a personal decision. The question to ask yourself is, what's the largest check I could comfortably write tomorrow for a car repair without it derailing my finances? For some people, that's $500. For others, it's $2,000. There's no right answer, only what's right for your budget. So that's collision. It covers your car when it hits something. But what about all the other bad things that can happen to a car? What if you walk out of the mall to find your car gone? Stolen? What if a massive hailstorm pummels your city, and your car now looks like a golf ball? What if a deer decides to play chicken with you on a country road at midnight? What about fire, floods, vandalism, or a tree branch falling on your hood during a windstorm? None of these are collisions. And that's where the second half of the full coverage equation comes in. Comprehensive coverage. Comprehensive, sometimes called other than collision coverage, is for almost everything else. It's the weird stuff and acts of God policy. It protects your car from damage not caused by a crash with another object. Just like collision, comprehensive coverage also has a deductible, and you can often choose a different deductible amount than you have for collision. Many people opt for a lower comprehensive deductible because claims are often less frequent, and you have zero control over them. You can be the safest driver in the world, but you can't stop a thief or a tornado. So, when you put it all together, what people call full coverage is really a three-part cocktail. You have your bodily injury and property damage liability to protect you from others, you have collision to protect your car in an accident, and you have comprehensive to protect your car from theft, weather, and a whole host of other perils. Now for the million-dollar question, do you actually need it? The answer might not be up to you. If you have a loan on your car or if you're leasing it, the answer is almost certainly yes. Your lender, the bank or credit union that financed your vehicle, technically owns your car until you pay it off. It's their asset and they need to protect their investment. They will absolutely require you to carry both collision and comprehensive coverage for the entire life of the loan. If you try to drop it, they can and will force-place a very expensive policy on your car and add the cost to your loan payment. It's non-negotiable. But what if you own your car outright? No loan, no lease. The title is in your name, free and clear. Now you have a choice to make. And it boils down to a simple, but sometimes difficult question. If your car was stolen or totaled in an accident tomorrow, Could you afford to repair or replace it without causing a major financial crisis in your life? To answer that, you need to consider two things: the value of your car and the state of your savings. Let's talk about the car's value. If you're driving a 17-year-old Honda Civic with 200,000 miles, faded paint, and a value of maybe $2,000, does it make sense to pay an extra $700 or $800 a year for collision and comprehensive? Probably not. Over 2 or 3 years, you'd pay more in premiums than the car is even worth. In this case, many people choose to self-insure. They drop collision and comprehensive, save that money on their premium, and accept the risk that if the car is destroyed, they'll have to buy a new one out of pocket. But what if you own a 3-year-old Toyota Highlander worth $30,000? The math changes dramatically. The risk of losing a $30,000 asset is huge. Unless you have that kind of cash sitting in a dedicated emergency fund, paying the premium for collision and comprehensive is a very wise financial decision. It's a way of transferring that catastrophic risk from your personal bank account to the insurance company for a predictable fee. But there's one more critical, often misunderstood, piece of this puzzle. When an insurance company pays out a claim, whether it's for a major repair or because the car is totaled, they don't pay you what you paid for the car. They don't pay what it costs to buy a brand new one today. They pay you something called the actual cash value, or ACV. Actual cash value is the replacement cost of the vehicle minus depreciation. The second you drive a new car off the lot, it starts to depreciate. It loses value due to age, mileage, and wear and tear. So, that car you bought 3 years ago for $35,000 might only have an ACV of $22,000 today. If it gets totaled, and you have a $1,000 deductible, your insurance company is going to send you a check for $21,000. Period. This is a shock to many people who assume they're covered for the full purchase price. So you've decided you need more than the state minimum. You've got your liability, your collision, and your comprehensive. You're feeling protected. But what about the gaps? What happens when that $21,000 insurance check isn't enough to pay off your $24,000 car loan? That's called being upside down. And it's a financial nightmare for millions of people. And what about getting a rental car while yours is in the shop for 2 weeks? Or needing a tow from the side of the highway at 2 a.m.? These are the crucial, often inexpensive add-ons that turn a good policy into a great one, and we're breaking them all down next. Let's start with the one that causes the most post-accident sticker shock: rental reimbursement. Imagine this. You get into a fender bender. It wasn't your fault, but the other driver's insurance is dragging its feet. Meanwhile, your car is in the body shop. The mechanic calls and says, "Yeah, we're waiting on a part. It's backordered. It's going to be about 3 weeks. 3 weeks. 21 days. How do you get to work? How do you pick up the kids from school? How do you get groceries? You need a car. So you call the rental agency. A basic sedan is going to run you, let's be generous, $45 a day. $45 times 21 days is $945. That's nearly $1,000 out of your pocket. An unexpected bill that you have to pay right now, just to live your normal life, all while you wait for your own car to be fixed. This is where rental reimbursement coverage becomes your absolute best friend. For a cost that is often less than a single fast food meal per month, we're talking maybe $3 to $6, your insurance company will pay for your rental car. Now, it's not a blank check. Your policy will have limits, which you'll see written as something like 30 of 900. This is the secret code. The first number, 30, is the maximum amount they'll pay per day, in this case $30. The second number, 900, is the maximum total amount they'll pay for the entire rental period, so $900. You can often buy higher limits like 50/1500 for just a couple of dollars more. When you consider that a single week in a rental can cost over $300, paying an extra $60 a year for this coverage isn't just a good idea. It's one of the highest value decisions you can make in all of personal finance. It turns a potential $1,000 crisis into a minor inconvenience. Next up is the hero of every dark and stormy night: roadside assistance. You're driving home late, the highway is empty, and suddenly you hear it. Flap, flap, flap. A flat tire. Or maybe you turn the key, and all you get is that dreaded clicking sound of a dead battery. Maybe you're in a rush and lock your keys in the car. In that moment, you feel completely stranded. Your first thought is to call a tow truck. But who do you call? How much is it going to cost? A simple tow can easily be $150 or more, depending on how far you are from a shop. A locksmith could be $100. A jump start? $75. These are surprise expenses that always seem to happen at the worst possible time. Roadside assistance coverage, sometimes called towing and labor, wipes that entire fear away. And I'm not exaggerating, sometimes as little as $1 or $2 a month, you get a 24/7 lifeline. This coverage typically includes towing up to a certain number of miles, battery jump starts, flat tire changes using your spare, fuel delivery if you run out of gas, and lockout services. It's the ultimate peace of mind for pennies a day. Now you might be thinking, I have AAA for that. And that's great, but it's worth comparing the costs. Often, the roadside assistance added to your car insurance policy is significantly cheaper than a separate motor club membership. It's about ensuring you're never left vulnerable or forced to pay an exorbitant price just to get back on the road. Now let's talk about one of the most common and most infuriating types of damage: your windshield. You're cruising down the freeway minding your own business when a semi-truck a few lanes over kicks up a rock. You see it for a split second before whack. A starburst crack appears right in your line of sight. By the next morning, it's a 12-inch line running halfway across the glass. This isn't just ugly. It's a safety issue that can compromise the structural integrity of your vehicle in a rollover, and in many states, it's a ticketable offense. So you call your insurance. You have comprehensive coverage, so you're good, right? Well, maybe. Let's say your comprehensive deductible is $500. You get a quote to replace the windshield, and with the cost of the glass, the labor, and recalibrating all the high-tech sensors and cameras mounted to it, the bill is $700. In this case, you would have to pay the first $500 out of your own pocket, and the insurance would only cover the remaining $200. For a lot of standard windshields that cost less than $500 to replace, you'd end up paying the entire bill yourself. This is why you need to ask about a specific add-on: full glass coverage, or a zero-deductible glass option. In many states, for a very small additional premium, this rider allows you to repair or replace your damaged automotive glass with a $0 deductible. That's right. That $700 windshield replacement now costs you nothing out of pocket. Considering how incredibly common rock chips and cracks are, and how expensive modern windshields with advanced driver assistance systems have become, this coverage can pay for itself many times over with just a single claim. It's an absolute must-have. Finally, we need to discuss the coverages that protect the most important thing of all: you and your passengers. This is medical payments coverage, often called MedPay, and its more comprehensive cousin, personal injury protection, or PIP. People get these confused all the time, but they are critically important. Let's say you're in an accident, and it's clearly the other driver's fault. Your arm is broken. The ambulance comes, you go to the ER, you have x-rays, you need a cast. Who pays for that? Eventually, the at-fault driver's bodily injury liability should cover it. But eventually is the key word. Insurance claims can take weeks, months, or if lawyers get involved, even years to settle. In the meantime, the hospital wants its money now. Your health insurance will kick in, but what about your $1,000 deductible? What about your 20% co-insurance? What about the $50 copays for follow-up appointments and physical therapy? This is the gap that MedPay is designed to fill. MedPay is a no-fault coverage, which means it doesn't matter who caused the accident. It provides immediate coverage for medical and funeral expenses for you and any passengers in your car, up to the limit you select, typically something like $5,000 or $10,000. It pays for those health insurance deductibles, the co-pays, and the ambulance ride right away without you having to wait for a settlement. It ensures you can get the care you need without worrying about the upfront cost. Personal injury protection, or PIP, is mandatory in some states, known as no-fault states. It works like MedPay on steroids. Not only does it cover medical bills regardless of fault, but it can also cover other economic losses, most importantly, lost wages. If that broken arm means you can't work for 6 weeks, PIP can help replace a percentage of your lost income, which can be an absolute lifesaver for your family's finances. It can also cover things like household services, if you're unable to perform them due to your injuries. Understanding whether you need or can get MedPay or PIP is crucial. It's the coverage that protects your health and your wallet when you are at your most vulnerable. So you've built the perfect policy. You have liability, you have collision and comprehensive, and you've added on these smart, high-value extras. You're covered from every angle. But what happens when the person who T-bones you at an intersection has no insurance at all? Or they have the absolute bare minimum state-required policy that doesn't even begin to cover your hospital bills after you're airlifted from the scene? This isn't a rare scenario. It's a terrifying reality for 1 in 8 drivers on the road. And it leads to the single most important coverage you've probably never heard of. We're diving into that nightmare scenario and how to protect yourself from it next. Imagine this. You're driving home after a long day. You're doing everything right. You're at a complete stop at a red light, listening to your favorite podcast. Suddenly, a violent metallic crunch shatters the peace. Your head whips back, then forward. Your car is jolted into the intersection. You're dazed, your neck is screaming in pain, and the smell of burnt rubber fills the air. The driver who hit you rushes over, panicked and apologetic. He admits it was his fault, he was looking at his phone. You exchange information, and that's when the second, colder shock hits you. He looks at his feet and mumbles, I don't have insurance. I'm so sorry, I let it lapse. In that single moment, his problem has become your catastrophe. Your $10,000 medical emergency. Your $50,000 surgery. Your months of lost wages. All of it now rests squarely on your shoulders. You can sue him, of course. But what if he has nothing? No savings, no assets, just a minimum wage job and an old car that's now totaled. You can win a lawsuit and be awarded $100,000, but you can't get blood from a stone. That judgment is just a piece of paper. A hollow victory that won't pay your hospital bills or put food on your table. This isn't a freak accident. This is the reality that 1 in 8 American drivers could inflict on you today. Look at the next 8 cars that pass you on the street. Statistically, one of them is a rolling financial time bomb, and if they hit you, you are the one who pays the price for their irresponsibility. This is why the single most important coverage you can buy is called uninsured and underinsured motorist protection. Let's call it UM/UM. It is, without a doubt, the unsung hero of the insurance world. Think of it this way. Liability coverage is insurance you buy to protect others from you. Uninsured motorist coverage is insurance you buy to protect you from others. Specifically, from the 1 in 8 who are driving illegally without insurance, or the millions more driving with laughably low state minimum policies. It breaks down into 2 critical parts. First, uninsured motorist bodily injury, or UMBI. This is your lifeline. If a driver with no insurance hits you and you're injured, your own insurance company steps into the shoes of the person who hit you. They pay for your medical bills, your lost income from being unable to work, and even for your pain and suffering, up to the limits you selected on your policy. It is the financial shield that stands between you and utter ruin. But the second part is just as crucial, and it's the one that trips up so many people. Underinsured motorist bodily injury, or UMBI. This protects you from the driver who technically followed the law, but is still a massive threat. Let's go back to that nightmare scenario. The driver who rear-ended you has insurance, but it's the state minimum for Texas. $30,000 for bodily injury. Your hospital bills, surgery, and physical therapy total $90,000, not to mention the $20,000 you lost in wages while you recovered. The other driver's insurance company writes you a check for their maximum of $30,000. That's it. They've fulfilled their legal obligation. You are now left with an $80,000 hole in your life. This is where underinsured motorist coverage rides in to save the day. If you have UIMBI coverage of, say, $100,000, your own insurance company will look at the situation and say, okay, the at-fault driver paid $30,000. The total damages are $110,000. We will cover the difference. They will pay the remaining $80,000, making you financially whole again. Without it, you are completely at the mercy of the other driver's terrible insurance choices. Let me make this crystal clear with a story. Meet 2 people, both named Alex. Both are 35, both work in graphic design, both get hit in the exact same way by a driver who runs a stop sign. Both suffer a broken leg and a dislocated shoulder, leading to $75,000 in medical bills and lost work. The at-fault driver in both cases has California's state minimum liability coverage, a pathetic $15,000. The first Alex A, wanted the cheapest insurance possible. To save a few bucks a month, he rejected uninsured and underinsured motorist coverage. The at-fault driver's insurance pays him the $15,000 policy limit. Alex A is now personally on the hook for the remaining $60,000. His health insurance helps with some of it, but he's still left with tens of thousands in deductibles, co-pays, and uncovered expenses. His savings are wiped out. He goes into debt. The stress of the bills makes his recovery slower and more painful. His life is derailed, not because of his mistake, but because he tried to save $12 a month on his policy. Now meet the second Alex B. He pays a little extra for a robust policy, including $100,000 in underinsured motorist coverage. He goes through the exact same process. The at-fault driver's insurance pays him the same $15,000. But then Alex B's own insurance company steps in. They see the $60,000 shortfall, and they cut him a check for that full amount. Alex B can focus on his physical therapy. He can pay his mortgage. He can heal without the crushing weight of a financial crisis brought on by someone else. For a few extra dollars a month, he bought himself peace of mind, and it paid off 1,000-fold. Which Alex do you want to be? Now you might be thinking, what about my car? That's where the other, less critical part of this coverage comes in. Uninsured Motorist Property Damage, or UMPD. This is designed to repair or replace your vehicle if it's damaged by an uninsured driver. However, there's a big overlap here with collision coverage, which we'll cover in detail soon. Collision pays for damage to your car regardless of who is at fault, even if you hit a pole. UMPD only kicks in if an identified, uninsured driver is at fault. For most people, having solid collision coverage makes UMPD redundant. But if you have an older car and you've decided to skip collision to save money, UMPD can be a very cheap, very smart safety net. Here is the most terrifying part of this entire conversation. In many states, UM and UIM coverages are optional. Your insurance company might even ask you to sign a form specifically rejecting them to give you a lower quote. They are legally required to offer it, but you are not legally required to buy it. This is, without exaggeration, the single worst financial decision a driver can make. Rejecting this coverage is like walking into a casino and betting your entire life savings, your health, and your family's future on the hope that none of the 30 million uninsured or underinsured drivers on the road will ever make a mistake that involves you. So how much should you get? The answer is simple and non-negotiable. Your uninsured and underinsured motorist limits should be exactly the same as your bodily injury liability limits. Think about the logic. If you decide that you need $250,000 in liability coverage to protect your assets in case you seriously injure someone else, you are acknowledging that a serious injury can cost at least that much. Why on earth would you give yourself less protection than you give a total stranger? You should value your own body, your own health, and your own ability to earn an income just as much. Match the limits. Period. We've now built the foundation. We've covered your legal responsibility to others with liability, and we've built a fortress around yourself with uninsured motorist coverage. This is the core of a responsible policy, but we haven't talked about the single biggest asset for most people, the car itself. What happens when the accident is your fault? What happens when a tree falls on your car in a storm, or a shopping cart rolls into your door, or a deer jumps out on a dark country road? This is where the two most famous words in auto insurance enter the picture: collision and comprehensive. But what they truly cover, how their deductibles actually work, and the secret ways they can save you or cost you a fortune is one of the most misunderstood parts of any policy. And that's exactly what we're breaking down next. Collision coverage is the hero you call when the accident is your fault. Let's be honest, it happens. You're looking at your GPS for a split second, you misjudge the distance in a parking lot, or you hit a patch of ice. When you cause an accident that damages your own car, this is the coverage that pays to repair or replace it. Think of it this way: your liability coverage, which we covered earlier, pays for the other person's car that you hit. Your collision coverage pays for your car. It also covers you if you hit an inanimate object, like a light pole, a fence, or the side of your own garage. It even covers single-car accidents where you might roll your vehicle or run off the road. Now, here's the most critical piece of the puzzle: the deductible. A deductible is the amount of money you have to pay out of your own pocket before your insurance company pays a single cent. It's your share of the repair bill. Let's say you have a $500 deductible. You get into a fender bender that you caused, and the body shop quotes you $3,000 for the repairs. You pay the first $500 directly to the shop. Your insurance company then pays the remaining $2,500. If the damage was only $400, you'd pay the whole thing yourself. Filing a claim wouldn't make sense, because the repair cost is less than your deductible. This is where you get to pull the financial levers. You choose your deductible amount, and it has a direct impact on your premium, the price you pay for the policy. A higher deductible, say $1,000 or $2,000, means you're taking on more financial risk yourself. In return, the insurance company will give you a lower premium. A lower deductible, maybe $250 or $500, means the insurance company takes on more risk, so they charge you a higher premium. The question you have to ask yourself is, could I comfortably write a check for my deductible amount tomorrow without breaking a sweat? If the answer is no, a higher deductible might be a dangerous gamble, even if it saves you a few bucks every month. So that's collision. It's for when your car hits another object. But what about all the other chaos the world can throw at your vehicle? What about the things that have nothing to do with your driving? That's where its partner, comprehensive coverage, steps in. Comprehensive is often called other than collision coverage, and that's the perfect way to think about it. It protects your car from damage from a whole list of things that are completely out of your control. We're talking about theft. You walk out in the morning and your car is just gone. We're talking about vandalism. Someone keys your paint job or slashes your tires. It covers fire, floods, falling objects like tree branches during a storm, and riots. And here is one of the biggest secrets that most people get wrong: hitting an animal. If a deer jumps out in front of you and you can't avoid it, the damage to your car is covered under your comprehensive policy, not collision. Why? Because the insurance industry views it as an unavoidable act of nature, not a driving error on your part. This is a huge deal, because a comprehensive claim is generally seen as less risky by insurers than an at-fault collision claim, meaning it's less likely to spike your rates. Just like collision, comprehensive coverage has a deductible that works the exact same way. You pick an amount, and that's what you pay first before the insurance kicks in. However, there's a fantastic little bonus that often comes with comprehensive coverage: glass repair. Many policies in many states offer a separate, much lower, or even a $0 deductible for windshield repair. That means if a rock flies up on the highway and chips your windshield, you can often get it repaired for free without paying your main comprehensive deductible, and it typically won't raise your rates. It's one of the best hidden perks of having the coverage. So, you have collision for crashes and comprehensive for chaos. Together, they make up what people call full coverage. But why are they almost always sold as a pair? And more importantly, who actually needs them? First, if you have a loan or a lease on your car, the decision has already been made for you. Your lender, the bank or credit union that financed the vehicle, will almost certainly require you to carry both collision and comprehensive coverage. Think about it from their perspective. Until you pay off that loan, they are the true owner of the car. It's their asset, their collateral. They need to protect their investment. If you total the car in an accident or it gets stolen, they need to know there's an insurance policy in place to pay off the remaining loan balance. They're not going to risk you defaulting on the loan and them losing the value of the car. So, if you're financing, full coverage isn't a choice. It's a contractual obligation. But what if you own your car outright? What if you have the title free and clear? This is where you face one of the biggest decisions in car insurance. Do you keep paying for full coverage, or do you drop it and go with liability only to save money? There isn't one right answer, but there is a right way to think about it. First, you need to know what your car is actually worth. Not what you paid for it, not what you think it's worth, but its actual cash value, or ACV. This is the amount an insurance company would pay you if your car were totaled today. You can get a good estimate from sites like Kelley Blue Book or Edmunds. Remember, your insurance will never pay more than the car's ACV, minus your deductible. Once you know the value, you can use a common industry guideline called the 10% rule. It's not a hard and fast law, but it's a great starting point. The rule says, if the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, you should seriously consider dropping it. Let's do the math. Say your car is worth $3,000. 10% of that is $300. If you're paying $500 a year just for the collision and comprehensive portion of your policy, you're paying a significant premium to protect a relatively low-value asset. In 6 years, you would have paid $3,000 in premiums, the entire value of the car, just to protect it. But the car's value is only half of the equation. The other, more important half is your personal financial situation. This is the gut check question. If your car was stolen or totaled tomorrow, could you afford to repair or replace it with cash from your own savings without causing a major financial crisis in your life? If you have a healthy emergency fund and could easily go out and buy another $3,000 car, then dropping full coverage is a calculated risk that might make perfect sense. You're essentially self-insuring. You're betting that the money you save on premiums over the years will be more than what you'd have to pay for a new car if the worst happens. However, if losing that car would be a devastating financial blow, if you rely on it to get to work and you don't have thousands of dollars sitting around to replace it, then keeping full coverage even on an older car might be the smartest thing you can do. In that case, the insurance isn't just protecting the value of your car. It's protecting your ability to get to your job, to take your kids to school, to live your life. It's a financial safety net. A slightly higher premium might be the price you pay for peace of mind. So we've covered liability, the coverage for others, and we've covered collision and comprehensive, the coverages for you. Together, they form the foundation of almost every auto policy in America. But this is where most people stop. They think that's all there is. They're wrong. The truth is, there's a whole other layer of optional coverages, the ones that protect you from uninsured drivers, from crippling medical bills, and from the nightmare logistics of being without a car. These are the coverages that separate a basic policy from an ironclad one, and they are what we're diving into next. Let's start with the ghost on the highway, the driver who exists but on paper is invisible. I'm talking about the uninsured motorist. Nationally, about 1 in every 8 drivers on the road with you right now has zero car insurance. 1 in 8. In some states, it's as high as 1 in 4. Think about that. On your daily commute, you will pass dozens, maybe hundreds of cars being driven illegally, with no financial backing if they slam into you. Now picture this. You're stopped at a red light, singing along to the radio. Suddenly, a violent jolt from behind. You're thrown forward. Your neck snaps back. Your brand new $1,000 phone flies off its mount and shatters. You get out shaken and see your trunk is now where your back seat used to be. The other driver gets out, avoids eye contact and mumbles, "I'm so sorry. I don't have insurance." What happens now? Let's play out the 2 scenarios. Scenario 1. You only have state minimum liability insurance. Remember what that's for? It's to pay for damage you caused to other people. It does absolutely nothing for you or your car in this situation. The other driver is legally responsible, sure. You can sue them. But what are you going to get? If they couldn't afford a basic insurance policy, they don't have thousands of dollars in assets sitting around to pay for your medical bills and your totaled car. You're left holding the bag. You'll be paying for your own hospital visits, your own physical therapy, and the entire cost of replacing your vehicle out of your own pocket. It is a financial catastrophe caused by someone else's irresponsibility. Now, scenario 2. You have what's called uninsured and underinsured motorist coverage. This is your personal shield against the ghosts on the road. This coverage steps in and acts like the insurance the other driver should have had. Comes in 2 critical parts. First, uninsured motorist bodily injury, or UMBI. This pays for your medical expenses, your pain and suffering, and your lost wages if you're hit by a driver with no insurance. It also covers you in a hit and run, where the driver is truly a ghost and you can't find them. The second part is uninsured motorist property damage, or UMPD. This is what pays to repair or replace your car. It fixes the damage the uninsured driver caused. Suddenly, that nightmare scenario becomes manageable. You file a claim with your own insurance company. They pay for your medical treatment. They cut you a check for your car. They handle the monumental headache, and then they can go after the uninsured driver to try and get their money back. But that's their problem, not yours. You are made whole. And what about that underinsured part? That's just as important. Let's say the person who hits you does have insurance, but they have the rock-bottom state minimum policy. Their policy might only cover, say, $25,000 in bodily injury. But you were seriously hurt. You have $100,000 in medical bills and lost work. Their cheap policy runs out fast. That's when your underinsured motorist coverage kicks in to pay the difference, all the way up to your own policy limits. Without it, you'd be stuck with a $75,000 bill. With it, you're protected. This single coverage is arguably one of the most important add-ons you can buy. It's not about trusting your own driving. It's about protecting yourself from the financial recklessness of others. Okay, so you're protected from the uninsured. But what about your own health? Let's talk about the alphabet soup of medical coverage, MedPay and PIP. These are designed for one thing: to get your medical bills paid fast, without waiting to figure out who is at fault. Let's start with medical payments coverage, or MedPay. This is an optional coverage in most states, and it's beautifully simple. It pays for medical expenses for you and anyone in your car who is injured in an accident, regardless of who is at fault. It doesn't matter if you caused the accident, someone else did, or a deer jumped out in front of you. If you get hurt in your car, MedPay helps pay the bills. Think of it as a pot of money set aside specifically for health costs. It can cover your health insurance deductible, co-pays for doctor visits, ambulance rides, dental work if you chipped a tooth on the steering wheel. You name it. The limits are usually modest, maybe $1,000 to $10,000, but it's designed to be a rapid response fund to handle those immediate costs without you having to pay a dime out of pocket, while the insurance companies spend weeks or months sorting out liability. Now, for those of you in what are called no-fault states, you'll have something even more robust: personal injury protection, or PIP. Think of PIP as MedPay on steroids. Like MedPay, it covers your medical bills regardless of fault. But it goes so much further. PIP can also cover lost wages if you're unable to work while you recover. It can cover the cost of hiring someone to do essential tasks you can no longer perform, like childcare or cleaning your house. In the most tragic circumstances, it can even cover funeral expenses. PIP is a comprehensive safety net, designed to keep your entire life from derailing after an injury. Because an accident isn't just about hospital bills. It's about the cascading effect it has on your ability to earn a living and run your household. PIP is the coverage that understands that. So UM/UIM protects you from others. MedPay and PIP protect you and your passengers. Your collision coverage is fixing your car. It seems like you're all set, right? But wait. The body shop says it'll take 3 weeks to get the parts and finish the repairs. 3 weeks? How do you get to work tomorrow morning? How do you take your kids to school? How do you get groceries? This is where the final and often overlooked pieces of a truly full coverage policy come in: rental reimbursement and roadside assistance. These aren't about million-dollar liabilities or life-altering injuries. They're about something just as critical in the moment: logistics and convenience. Rental reimbursement coverage is exactly what it sounds like. It pays for a rental car while your vehicle is in the shop being repaired after a covered claim. It's usually sold with a daily and a total limit, for example, $30/900. That means the policy will pay up to $30 a day for a rental, for a maximum of 30 days or a total of $900. For the price of a couple of cups of coffee a month, you eliminate the massive headache and expense of being without a vehicle. Trying to find a few hundred, or even $1,000 to rent a car for a few weeks is a huge, unexpected bill that most people aren't prepared for. This tiny add-on makes the problem disappear. Your life doesn't have to grind to a halt just because your car did. And speaking of grinding to a halt, let's talk about roadside assistance. This is another inexpensive add-on that can be an absolute lifesaver. It's 2 in the morning. You're on a dark, unfamiliar road, and your tire blows out. Or your battery dies in the airport parking lot after a long trip. Or, in a moment of distraction, you lock your keys in the car. Without roadside assistance, you're frantically searching on your phone for a local tow company, with no idea what they'll charge or how long they'll take. With this coverage, you just call the number on your insurance card. They dispatch a locksmith, a tow truck, or someone to give you a jump start. It covers towing, tire changes, fuel delivery, and lockout services. The cost of one emergency tow can often be more than the cost of having this coverage for an entire year. It's simple, it's cheap, and it provides incredible peace of mind. So let's step back and look at the fortress we've just built. State minimum liability was the flimsy wooden fence the law required you to have. But now we've added the steel walls of collision and comprehensive to protect your car. We've built a watchtower with uninsured motorist coverage to protect you from irresponsible drivers. We've staffed a medic station with MedPay or PIP to heal your injuries quickly. And we've established a logistics department with rental reimbursement and roadside assistance to keep your life running smoothly through any crisis. This is the difference. This is what people mean when they say full coverage. It's a system of interlocking protections designed not just to meet a legal requirement, but to safeguard your health, your property, and your financial future. Now we know all the pieces: liability, collision, comprehensive, UM/UIM, MedPay, rental. It's a lot to take in, but knowing what they are is only half the battle. The real question, the one that determines what you'll actually pay, is how much of each do you need? How do you choose the right limits? Is $100,000 of liability enough? Or do you need $1 million? How low can you set your deductible before it's a bad idea? Choosing these numbers is the art of building a policy, and it's where you can save a fortune or leave yourself dangerously exposed. And that is exactly what we are going to break down next. Let's start with the big one: liability limits. This is the part of your policy that pays for the damage you cause to other people and their property. When you see numbers like 25/50/25, that's your liability limit. The first number is the maximum. In thousands of dollars, your insurance will pay for any single person's bodily injuries. The second number is the maximum they'll pay for all bodily injuries combined in a single accident. And the third is the maximum they'll pay for property damage. So 25/50/25 means your policy will cover up to $25,000 for one person's injuries, $50,000 total for everyone's injuries, and $25,000 for property damage. Now, many state minimums are in this exact range. And I'm going to tell you right now, that is terrifyingly low. It might keep you legal, but it will not keep you safe. Let me paint you a picture. You're driving home, you glance down at your phone for just a second, and you rear-end a brand new Honda Pilot at a stoplight. It's a simple mistake, but the Honda lurches forward into a Lexus, which then bumps a Tesla. You just caused a 3-car pileup. The driver of the Honda has a neck injury, whiplash. The passenger in the Lexus has a broken wrist. The Tesla has complex sensor damage. Let's tally the bill. The Honda driver's initial medical bills, plus physical therapy, come to $30,000. Your $25,000 limit for a single person is exhausted immediately. You are now personally on the hook for the remaining $5,000. The Lexus passenger's broken wrist, ER visit, and follow-ups cost $15,000. Okay, your $50,000 total injury limit can cover that. So far, you've used $25,000 for the first driver and $15,000 for the second, totaling $40,000. But what if the Honda driver needs surgery later? What if they sue for pain and suffering? That $50,000 total limit is looking smaller and smaller. Now for the cars. The damage to the Honda Pilot is $8,000, the Lexus $12,000, and the Tesla, with its specialized parts, is a whopping $15,000 in repairs. The total property damage is $35,000. Your policy's property damage limit? $25,000. You are now personally responsible for that extra $10,000. In a split-second accident, you're already $15,000 in debt, and that's before the lawyers get involved. They will come after your savings, your investments. They can even garnish your future wages. Everything you've worked for can be wiped out because you tried to save a few bucks a month on car insurance. This is why settling for state minimums is one of the biggest financial gambles a person can take. So what's the right number? A good starting point for most people is 100/300/100. That's $100,000 for a single person's injuries, $300,000 total for injuries, and $100,000 for property damage. In today's world of $60,000 pickup trucks and advanced safety systems, $100,000 in property damage is a much safer bet. If you own a home or have significant savings, you should seriously consider going even higher to $250/500/100. The cost increase to raise your liability limits is often surprisingly small. We're talking maybe $10 to $20 a month to get hundreds of thousands of dollars in extra protection. It is the single best value in all of insurance. Next, let's talk about collision and comprehensive deductibles. This is where you get to customize your risk. The deductible is the amount of money you pay out of pocket before your insurance kicks in to fix or replace your car. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. It's a seesaw. The question you have to ask yourself is this: how much cash can I comfortably access on short notice without causing a financial crisis? If you choose a $1,000 deductible, you're telling the insurance company, I'm willing to handle the first $1,000 of any repair bill myself. In exchange, they give you a lower rate. If you choose a $250 deductible, you're saying, I want a smaller personal risk, and they charge you more for that privilege. Let's say the difference between a $500 deductible and a $1,000 deductible saves you $25 a month on your premium. That's $300 a year. So by taking on an extra $500 of risk, the difference between the two deductibles, you save $300. In this scenario, it would take less than 2 years of being accident-free to have saved more than the extra risk you took on. So what's the sweet spot? For most people with a decent emergency fund, a $500 or $1,000 deductible is the way to go. It provides a significant premium savings without exposing you to a catastrophic out-of-pocket cost. If you have a brand new car and want maximum peace of mind, a $250 deductible might be worth the extra cost. If you have a huge emergency fund and want the lowest possible premium, you could even look at a $2,000 deductible. But never ever choose a deductible that you couldn't pay tomorrow. If you have to go into credit card debt to pay your deductible, it's too high. Now for one of the most important, yet overlooked coverages: uninsured and underinsured motorist protection, or UM/UIM. This protects you when the person who hits you has no insurance or not enough insurance. Think about that. You can have the best policy in the world, but it won't help you if the at-fault driver is a ghost. According to the Insurance Research Council, about 1 in every 8 drivers on the road in the United States is uninsured. That's a terrifying statistic. Imagine you're sitting at a red light, and someone slams into you from behind. They're clearly at fault. Your car is totaled, and you have a back injury that requires months of treatment. The other driver gets out, apologizes, and then admits they let their insurance lapse. They have no money, no assets. Who pays for your medical bills? Who buys you a new car? Without uninsured motorist coverage, the answer is, you do. You'd have to sue them personally, which is like trying to get blood from a stone. Your life could be turned upside down by someone else's irresponsibility. Uninsured motorist coverage steps in and acts as the at-fault driver's insurance. It pays for your medical bills and, in some states, your car repairs. Underinsured motorist coverage is similar. It kicks in when the at-fault driver has insurance, but their low liability limits aren't enough to cover your bills. My recommendation here is simple and non-negotiable. Get this coverage and set the limits to be equal to your own liability limits. If you have 100/300 in liability, you should have 100/300 in UM/UIM. It's incredibly cheap for the protection it offers, and it's financial malpractice to drive without it. Finally, let's touch on a few other key pieces. Medical payments or MedPay and personal injury protection or PIP. The availability of these depends on your state. They both cover medical expenses for you and your passengers after an accident, regardless of who is at fault. This is crucial. It means you can get immediate medical care without waiting for the insurance companies to fight over who's to blame. If you have a high-deductible health insurance plan, a small MedPay or PIP policy of $5,000 or $10,000 can be a lifesaver, covering your health plan's deductible so you don't have to pay it out of pocket. Then you have the add-ons like rental reimbursement and roadside assistance. Rental reimbursement pays for a rental car while yours is in the shop after a covered claim. Is it worth it? Think about it. It might cost you $5 a month. That's $60 a year. A week-long car rental can easily cost $300 to $500. For most people, this is a no-brainer. Roadside assistance covers things like towing, flat tires, or jumping a dead battery. It's also very cheap, but check first. You might already have this service through your credit card, your car's manufacturer, or a membership like AAA. Don't pay for the same service twice. Building the right policy is a balancing act. It's about protecting your assets with high liability limits, choosing a deductible that matches your personal financial situation, and insuring yourself against the unknown with critical coverages like uninsured motorist. It's not about finding the absolute cheapest price. It's about finding the smartest value. But even after you've built the perfect policy, there's one final massive question we have to answer. A question that could change everything we've just discussed. What happens when your car gets older? When does it stop making sense to pay for full coverage at all? This is the financial tipping point. It's the moment a decision you make in a few minutes could either save you thousands of dollars over the next few years, or cost you everything in a single instant. So, how do you know when your car has crossed that invisible line? When does it officially become a bad deal to keep paying for full coverage? The answer isn't a date on a calendar. It's a number. And the most common rule of thumb financial advisors use is called the 10% rule. It's incredibly simple. If the annual cost of your comprehensive and collision coverage is more than 10% of your car's current value, it's time to seriously consider dropping it. Let's break that down. First, the most important phrase, your car's current value. This is not what you paid for it. It's not what a new one costs. It is the actual cash value or ACV. That's the amount an insurance company would write you a check for if your car were totaled today. It's what someone would realistically pay for it on the open market, considering its age, mileage, condition, and trim level. You can get a very good estimate of this for free on websites like Kelley Blue Book or Edmunds. Don't guess. Look it up. Second, the annual cost of your comprehensive and collision coverage. This is critical. You are not looking at your total insurance premium. Your total premium includes your liability, your uninsured motorist, and other coverages we've talked about. You are never going to drop those. You need to isolate the cost of just the physical damage protection for your own car. You can find this on your policy's declaration page, usually listed as 2 separate line items. Add those 2 numbers together for your 6-month premium, then double it for the annual cost. Now let's put it all together with a real-world example. Let's say you have a trusty 2014 Honda Accord. It's paid off, running great, but it's got 140,000 miles on it. Step 1. You go to Kelley Blue Book and punch in the details. It tells you the private party value, the ACV, is about $5,000. Step 2. You pull out your insurance bill. You see that you're paying $250 every 6 months for collision and $100 for comprehensive. That's $350 for 6 months, which means you're paying $700 per year specifically to protect the value of your car. Step 3. You apply the 10% rule. What is 10% of your car's $5,000 value? It's $500. You are paying $700 a year to protect a $5,000 asset. The rule of thumb says you should be paying no more than $500. According to the math, you are overpaying. It seems like a clear-cut case to drop full coverage and save that $700 bucks. But this is where most people stop. And stopping here is a huge mistake. The 10% rule is not a law. It's a starting point for a much more important, much more personal conversation. The real decision comes down to one question. Can you afford to replace your car with cash tomorrow? When you drop collision and comprehensive, you are essentially becoming your own insurance company. You are self-insuring. You are taking that $700 a year you were paying to Progressive or Geico and, in theory, putting it in your own pocket. But in exchange, you are also accepting 100% of the risk. If your car gets stolen, if a tree falls on it, if you slide on ice and hit a guardrail, you get a check for $0. The car is gone, and nobody is coming to help you buy a new one. So look at your bank account. Do you have $5,000, $6,000, $7,000 in an emergency fund that you could use to buy another reliable used car without derailing your entire financial life? If the answer is a confident yes, then self-insuring makes a ton of financial sense. You're betting on your own good driving and a little bit of luck, and over a few years you're almost guaranteed to come out ahead. But if the answer is no, if losing your car would mean you couldn't get to work, you'd have to drain your retirement savings, or go into high-interest debt just to get back on the road, then the math of the 10% rule becomes irrelevant. The risk is too high. That $700 premium isn't just a fee. It's buying you certainty. It's the peace of mind of knowing that a single bad day won't trigger a financial catastrophe. And there's another layer we have to add. The deductible. Let's go back to that Honda Accord. It's worth $5,000. You're paying $700 a year for full coverage. But let's say you have a $1,000 deductible. If you total that car, the insurance company isn't going to give you $5,000. They're going to give you the actual cash value minus your deductible. So, the maximum possible check you could ever receive is $4,000. Now the math looks different. You're paying $700 a year to protect a potential $4,000 payout. That means you're paying almost 18% of the car's protected value in premiums every single year. You'd have to go more than 5 years without a single at-fault accident just to break even. When you factor in the deductible, the argument for dropping full coverage on an older, lower-value car becomes incredibly strong, if you have that financial safety net in place. So what's the final verdict? It's a flowchart. First, do you have a loan or a lease on your car? If yes, the decision is made for you. Your lender requires you to maintain full coverage to protect their investment. End of story. If your car is paid off, move to the next question. What is its actual cash value? Look it up. Then, what is the annual cost of only your collision and comprehensive coverage? Now apply the 10% rule. Is the annual premium more than 10% of the car's value? If it is, you've reached the final, most important question. If you were in a total loss accident tomorrow, could you comfortably buy a replacement car with cash you have on hand, without causing a major financial crisis? If the answer is yes, then it is very likely time to drop full coverage, save the money, and start self-insuring. If the answer is no, you should probably keep the coverage even if the math seems off. The peace of mind is worth the premium. You can work on building up your emergency fund, and then reevaluate at your next policy renewal. Because that's the key. This isn't a one-time decision. You should be asking these questions every year. Your car's value is constantly dropping, while your insurance rates can be changing. Set a reminder on your phone. Every 6 months or every year when that renewal notice hits your inbox, take 10 minutes. Look up the new ACV. Check the premium. Reassess your emergency fund. Make a conscious choice, don't just let it roll over on autopilot. That's what this has all been about. From the very first minute of this video, our goal was to take you from a place of confusion, where insurance is this complicated thing that just happens to you, to a place of control. A place where you are the architect. You no longer have to guess what state minimum means. You know it's a financial trap. You don't have to wonder about liability limits. You know how to choose numbers that protect your entire future, not just your car. You understand the hidden value of uninsured motorist coverage and the optional protections that might be perfect for your life. You know how to customize your deductibles and stack discounts to build a policy that is perfectly tailored to your needs and your budget. And now, you know exactly when and how to make the critical decision to scale back your coverage as your car ages. You are now in the driver's seat. The goal was never to find the absolute cheapest policy. The goal was to build the smartest one, to understand the risks you face, and to make a deliberate, informed decision about which ones you want to pay an insurance company to handle, and which ones you're comfortable handling yourself. That knowledge is the ultimate coverage. It gives you the confidence that you're not overpaying for things you don't need, and the peace of mind that you're truly protected if the worst should happen. Your next step is simple. Don't just close this video and forget about it. Pull out your own policy. Go to Kelley Blue Book. Run your own numbers. Take 5 minutes to move from being a passive customer to being an active, empowered manager of your own financial protection. And if this journey we've taken together has helped you do that, if it's clarified something you were confused about, or if it's going to save you money or protect you better, do us one small favor and hit that subscribe button. Because our entire mission is to give you the clarity and confidence to take control of every piece of your financial life, one smart decision at a time. Thank you for watching.